All right. So welcome to topic 2. So now we're talking about underwriting. And so with underwriting, we first want to take a look at the term insurable interest. Oh, so now right, topic 1, we had a lot of vocabulary. Now we're introducing even more vocabulary. So really try and take time to do whatever helps you to really understand these terms and not get them confused. So insurable interest exists if an applicant is in a position to suffer a loss should an insured incur medical expenses or be unable to work due to disability. So this is important, right? So you can't just purchase insurance on a stranger that you met, right? Um, Remember, the applicant is in a position to suffer a loss should an insured incur medical expenses, unable to work, or pass away. So examples include the wife has insurable interest on her husband's life, right? So think about some other examples now. What are some other examples? Okay, so let's go over some. We can have a parent and a child, right? We can also have employee and employers, right? They also have that relationship of, oh, well, we actually with like group, right? That's why your employer can purchase insurance on you, right? The employee, because if you pass away, right, or incur medical expenses, then the employer, right, is in the position to suffer loss, right, financially. Okay. Now, remember, sometimes you might purchase insurance on yourself, right? So what happens then? Well, the good thing is you have insurable interest on yourself. So you're welcome to purchase insurance on yourself because you have insurable interest on yourself. And something important to note is that insurable interest must exist between the policyholder and insured only at the time of the application is made. So, eventually there might be changes, right? Especially with like the wife and the husband, right? There might be relationship changes, maybe with the employee and the employer, right? Maybe the employee didn't work at the same location anymore, right? But the policy will still remain active, right? Um, because insurable interest must only exist between the policyholder and insured at the time, right, when the application is made, right, at the time when the application is signed. Okay, so something that we want to talk about is the stranger or an invested owned life insurance. So this is where a third-party agent or broker will purchase and pay premiums for the consumer's policy and receive proceeds as a profit upon the consumer's death. So let's kind of summarize what this is talking about. This is basically saying when a third party owner will be the one benefiting from the death of the insured, right? Because the third party owner is paying for the premiums of someone's policy, right? The consumer's policy, but also receiving the proceeds. So in this case, it would violate insurable interest requirements, right? Because this third party owner is paying for the premiums of a consumer and receiving proceeds, right, upon the death of that consumer, right? But remember, there's no relationship, right? There's no right, loss that would be suffered, right, by the third party agent. So in that case, these types of insurance, right, are typically illegal because they violate this requirement. Okay, so now let's talk about underwriting. So remember, with underwriting, right, the first important thing is that, right, there must be insurable interest, right? But after that, right, we also want to think about, well, what are resources to really classify the individual, right? And this is called risk classification. So what resources do they have? Well, we just talked about a lot of resources in module 1, right? The medical information report, right? Or the medical information bureau. I talked about the consumer report, right? The credit report. So all of that is utilized. All right, you really want to go back to review topic one because all of this is interconnected. Okay. So let's go into thinking about risk classification. So risk classification is dependent on, right, many things that the client discloses, right, or that is disclosed to them so that the insurance company can utilize that information. Okay. Um, Now with risk classification, there are four categories. So first category is preferred, right? So these are for individuals that have better than average risk. So they pay lower premiums. And for example, right, they might be non-smokers, their weight might be within the ideal range, they're not a drinker, right? They haven't had any major diseases, any chronic diseases, right? Um, so with this, they would have preferred risk classification, right? Now with standard, right, this is average risk, right? So there you don't get you don't get to pay lower premiums, right? But you also don't need to pay higher premium, right? The client doesn't need to pay the higher premiums. So will just be the standard terms and conditions. Now, with substandard, these are individuals with high risk, right? So, right, there might be individuals with chronic conditions. They might be suffering from diabetes. They might have heart disease. So in this case, they will need to pay higher premiums. Why? Well, because they have a higher risk, right, of maybe passing away at earlier age or developing other health conditions. So because of that risk, right, because of that risk, they'll need to pay higher premiums or they'll have restricted coverage. So sometimes there'll be restrictions too, right? Saying, oh, well, that will be excluded. And we'll take a look at that, especially in module 3. But sometimes there might be exclusion of coverage of certain conditions. And then lastly, right, individuals might be declined, and this happens really often, right? We as agents hope that the clients aren't declined, and we really try and help the client find a appropriate insurer. But sometimes, right, there will be many rejections from the insurer because the individual has too many terminal illness, too many chronic conditions, is terminally ill. Age also plays a factor, right? If you do tobacco or not. So it's a really holistic review process, and they look through all of these factors, right, as part of their underwriting process. And again, they get this information from the MIB, right, consumer report. Credit still plays a role as well, right?